let's go to that. Being a trading business, it has a couple of complicating factors. One, when we deal with credit transactions, when we purchase items, sometimes items are not to our specifications, sometimes they're faulty, and we need to return them. Okay, so there's this thing called purchase returns allowances that I must show you how to do. And similarly, the same happens for sale. When one of our customers are not satisfied, they might return goods to us, whether it's faulty or not to their desired specifications. So they return for us. So we must account for that. So there's that complicating factor, as well as when we sell goods, we must account for the cost of goods sold. So we've got two complicating factors there. One, the returns, and two, to calculate the cost of goods sold, which I'll show you using this illustrative example, which is illustrated to you on page 84. Alright, let's start. The first entry, December the 1st, purchased good from General Electric for $1,870 GST inclusive. Okay, so the date, December the 1st, the particulars, we bought some inventories to put on our shelves. We have this complicating factor that we've got to calculate 1/11th of that for the GST component. So I'm just going to put that there, credits received. Okay. Remember that when we purchase stuff, we record the rebate that we're going to get on the debit side. So 11th of that is $170. So the remainder is $1,700. So we purchase something for $700. The seller to us, they put on the GST component, so the total that we have to pay is $1,870. In this instance, it was a supplier that we haven't paid yet, so it is a liability that appears on the credit side for $1,870. There we have it. That's one of those items I did before, which is very similar to when we purchase any other good or service, like an expense, like you saw in the previous example. Okay, you've got the GST credits received, which ends up being a rebate that we're going to rebate back from the government. Alright, so that's the first entry. Now, on the third, what happened on the third, if you look at the next entry, we returned some goods. They weren't to our liking or specification. So essentially what we need to do is to mirror this entry up here, turn everything upside down, which really means what was on the credit side and that goes on the debit side and so on, because we're returning those goods if we don't have them anymore. It's another way of looking at it. So what we do, in the first instance, General Electric was the account there. The amount that we're returning is $220. All right. We also must reverse the amount of GST that we originally claimed for this rebate. The 11th of $220 is $20. I'm going to put that in this quickly there. So that is GST credits received. And inventories obviously goes down because we initially bought that many inventories. The difference between those two items is obviously $200. And the amount of inventories, as you can see here, has gone down. Okay, remembering, just going aside to thinking about your debits and credits in relation to your ledgers. Okay, you had a debit entry to inventories there, a credit entry there, so we actually left with $1,500 worth of inventories on the debit side. That's the net effect of these two transactions. Okay, let's keep moving. On December the 15th, we had a sale. And this is where we've actually got to do two entries to calculate the cost of goods component. So let's just first of all generate the sale, the revenue side of things, which is very similar to the service performed. So this was a cash transaction. So put that in. It was for $770. The GST component is 11th of that, which is $70. The amount of sales that we made is $700. Okay, the difference between the cash at bank and the GST component. So that was very similar to when we charged or performed some services. But we have sold $770 worth of stock, and we must adjust that level in our stock levels. And this is where I'm going to introduce a new entry. It's called cost of goods sold, also called COGS for short, and that'll be an abbreviation that I'll be using. Now, in your instructions it said that we sold goods for $770, but they only cost us $400. So the difference is obviously the amount that we use to cover our costs and to make a profit. So, but our cost of goods sold was $400, and if you think about it logically again, inventories need to go down to reflect the lower stock level. That's why it's a credit, and that hopefully makes sense to you. Right? If I keep going with the earlier example, when we returned inventories, we took them out, it reduced it on the credit side, and now we sold some, it again reduces the inventory account on the credit side. Okay, let's keep moving on. December the 22nd, we purchased some goods for cash, but they're GST free. Remember I told you earlier that some inventories or some items don't attract the GST. So that was for $550. It was for cash. There we are. So that's quite nice and easy. Be careful to read these instructions, to read these transactions, to see whether it's GST inclusive or GST free. You might have thought, being 550, oh yeah, it's divisible by 11, I must take a GST component. They do that deliberately in these type exercises to put you off a bit, but be careful when you read the transactions. Alright, December the 28th, we sold some more stuff, this time to M. Viviani. There we are. That person bought $1,615 worth of goods from us. It's got a GST component. Let's do my spelling a little bit better here. There we are. It's the 16th of that, which is $150. Amount of sales is $1,500. What we've got to do, we've got to work out what the cost of sales component of that transaction is. I'm just going to use the abbreviation here called COGS. Okay, in the book they told us that's $14.56 for the cost of goods sold component. The inventories went down by the same amount. So what we've done there, we've recorded the sale and we've recorded the decrease in inventories along with our cost of goods sold. Now the last transaction is a little bit different. It's a sale return. In effect, it's really again the opposite to this, with just one minor variation which I'll note. Let me just go through it step by step. So December the 31st, what we've got first up, I'm going to reverse this part here. Now the transaction says that this $165 worth was returned by a customer, M. Viviani. Okay, but instead of saying sales, we have this other account called sales returns, which is just a slightly different account, and we must separate that one. Oops, made a mistake already here, because what I've forgotten is the GST component. There we are. Now, M. Viviani returned $165 worth of stuff. I'm just going to put that in, okay, to make it more obvious. 11th of that is 15, which is the GST component. Now, you might think this is getting fairly complicated, but if you think about it, up here, M. Viviani, he created the debt to us. He owes us $1,650. We're going to have to pass on $150 worth of tax to the government, and we get sales of $1,500. But that's been reduced by this amount of sale return. So you can see that this GST collected decreases that, and every M. Viviani, 465, decreases there. So the net amount is actually how much he owes, and the net amount we actually have to pay to the government in terms of the GST component. So from that perspective, hopefully that makes sense. Also, what we must do is to recognise that some inventories have come back to us. In this instance, it was $130 worth, and the cost of goods sold has gone down because that amount has been reduced by the amount that we received back from our customer. So hopefully that's been a good illustration to you on how to record the general journal entries for a trading enterprise. Remember that we had the complicating factor of returns, both on the sales and purchases side, as well as having to account for the cost of goods sold and the reduction in inventories. Now take a bit of a pause. You'll be getting plenty of exercises from me to practice this, but for the purposes of the demonstration I've got one section to go, and that's to do with other transactions, which I'll get into now as well. But you'll listen to this a little bit later.